Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Monday. It is September the 25th. It's almost the end of the month. Can you believe it? Almost the end of September, and we're in the final quarter, October, November, December, and we're going to wrap up 2023. I want to talk a little bit about Devon. Devon is one of those stocks where I made a call, which was probably a little bit too early when Devon was trading in the sort of $56, $57 range. And I said, it might be a good time to get into to Devon. It came off a high at that time of around $76, $77 or thereabouts. So it was down $20. And I thought now might be a good time to open a position if you were interested in doing so as it relates to Devon. Now, I might have been a little early on that call. And I remember when I was making the video, I said I would have preferred to open a position at around $50. But, like sometimes you are just a little bit too quick on the trigger. It's one of those examples of ready, fire, aim, instead of being a little bit patient. However, right now, Devon is trading at around $50 or thereabouts, so maybe it's a good time to have a look at it again and see what you can do if you're interested. So Devon, just for people who don't know the company, Devon Energy is an independent energy company. They engage primarily in the exploration, development, and production of oil, natural gas, and natural gas liquids. They have a few really great properties, mostly in the Delaware Basin and Anadarko Basin, and a couple of others. The Delaware Basin operates approximately 16 rigs that offer exploration and development opportunities. 4 rig programs with an Anadarko joint venture. As it's not Anadarko the company, but the Anadarko Basin, so a little different for people who are familiar with it. But what I thought I would do, just as a sort of an introduction to get us started, is maybe look at a comparison of 5 different companies, Devon being one of them. And what I did was I went into my brokerage website and looked at some of their peers to decide which ones I am going to use for the purposes of my comparison. Now, right at the bottom of the screen here, you can see the companies that I'm comparing. It's Devon compared to Hess, compared to Kinder Morgan. It's primarily a pipeline operator, but we'll go with oil production and pipeline. And then OKE and Coterra Energy. So if you look at the actual companies, firstly, they're all traded on the New York Stock Exchange, so that's kind of a fair comparison. In other words, they don't have any of these in an emerging market or something like that. And then if you look at the description of the company, we have 2 of them. So Coterra and Devon are U.S. exploration and product, and then the others are just slightly different. So I have one, Hess, which is U.S. integrated, Kinder Morgan, which is production and pipeline. And of course, most people know Kinder Morgan is a pipeline company. And then I have OKE, which is gas production and pipeline master limited partnership, MLP. For the technical guys, let's just take a quick look here and see what's going on. So the interesting thing here, if you want to discount any of them or eliminate any of them based on the technicals, we look at the 20-day raw stochastic over here. And remember, if it's 80% or above, it is overbought. So right now, people are basically saying OKE or 1OK is overbought with a stochastic score of over 80%. Conversely, if it's below 20%, then it's oversold. And these include 2 of the stocks I'm sharing here with you, one being Coterra Energy and the other one being Devon. Now, when you look at the opinion of the analysts, even though both of these are effectively oversold, according to the raw stochastic, they are very, very different, because the analysts are predominantly saying sell on Devon, and predominantly, or the majority of them, are saying buy on Coterra Energy. And then the price earnings ratio on a trailing 12-month basis always gives us a really good idea as to whether the stock is actually trading good or not. And right now we can see that both of these, Devon Energy with a price earnings ratio of around 7.5 and Coterra at around 7.5, seem to be a really good buy right now, one or the other. But, for the purpose of this discussion, I'm going to focus predominantly on Devon. A couple of sort of highlights, or maybe lowlights, reels, if you're following the performance of the stock. And once again, I'm looking here sort of more over a longer period. So my Devon position, and I currently have a position with a cost basis that's averaged just under $50, like literally just under $50 is like $49.76 or something like that. So I'm looking more sort of a longer term. Anyway, my view in general is longer term. With my typical hold period, sort of 3 to 5 years. But take a look down here at the bottom, 6 months. Devon is still up just a little, But if you were invested in Hess, you are probably smiling all the way to the bank, up 34% in the last 6 months. And the others kind of did okay, so Kinder Morgan, worst performer of the 5-year, and Devon coming in second last. The others kind of okay, and Hess pretty good, over a 6-month period. If you can sock away a 34% gain, and in addition to that, earn some dividends, that's a sweet deal. Let's look at the key statistics here for a second. We compare one with the other. What I'm looking at here specifically, it's one of those ratios, much like the price earnings or the 20-day roll stochastic. What I'm looking at here specifically is what is the relationship between the annual sales, which, as you can see where I'm spinning my little mouse cursor here, is $19 billion for Devon Energy. And what we have at the top is a market cap of only $31 billion, right? So when you express this as a percentage, the market cap is 165% greater than sales. Now, if you look at this one over here, this is Hess. One of the reasons why it's performing so well is not related necessarily to its annual sales, because comparatively, its sales are only 11 billion compared to Devon's 19, but its market cap is almost $50 billion, which means its market cap is 430% its annual sales, right? So sometimes these stocks fly and they take off, and of course, when the stock price is high, then the market cap is high. So in case you don't remember, the market capitalization is the total number of outstanding shares multiplied by the current share price. So if the share price is high and the shares outstanding haven't changed much, the market cap's going to go high, and that's why you end up with 430% here, because Hess has been performing really well as a stock. So if you have Hess in your portfolio, congratulations, you did better than what I did with my Devon. Annual sales for Kinder Morgan, 19 billion, so very similar to Devon Energy, but its market cap is greater, almost 38 billion, and so on and so on. You can see where I'm going here. Here's another outlier for us on Coterra, only, relatively speaking, 9 billion in sales, but with a market cap of 21 billion, is 233%. Right here at the bottom, you can see that you've probably just missed the ex-dividend date, and that's the date you have to be into the stock before if you want to earn dividends this time around. And so just a week ago or so was the ex-dividend date, so you had to own Devon Energy on September 13th, for example, and Hess on September 14th to earn a dividend in the upcoming quarter, whenever that payout might be. So it's too late to get any of these if you just wanted to jump in on the dividends. But of course, dividends are paid quarterly for all 5 of these, so you can have another turn. If we look at the graphs over a 1-year period, once again, we have this outlier here, which is Hess at almost 40%. And then OKE has done okay at around 17%. And then the others are negative, with Devon, unfortunately, for people like me who are now long Devon, being the outlier here, where it's been the worst performer. But, sometimes the worst performer means this is the best time for you to potentially get into the stock. So not everything is necessarily bad when the stock price is really, really low. Let's take a closer look here at Devon. I'm just going to do a sort of, let's call it a shallow deep dive, just to be a contradiction in terms. The stock price right now around $47, so under $50. As I said a few minutes ago, my own average cost base is around 49. So right now I'm down, a couple of percentage points on Devon, trading sort of at around $47 or thereabouts. $30 billion market cap, positive earnings, nice PE ratio if you wanted to open a new position. If you have an existing position in Devon, like I do, you could probably just hold it. I wouldn't sell it necessarily. You can always trim a little bit if you have to do a little bit of a portfolio rebalancing or cost averaging or something like that. You can cost average for sure by potentially adding a little bit more Devon long if your cost basis is higher than that. But I'd be cautious to just jump in boots and all, right, because we don't know where it's going. It's certainly over the 52-week period sitting way to the left, right? So this is arguably, figuratively speaking, if nothing else, sort of as low as it can go. Remember, if you bought one share of Devon Energy your maximum loss is capped at $47.22 using my slide over here. If you bought one share, the most you can lose is $47. On the other hand, the most you could gain is, relatively speaking, unlimited, because if Devon goes to, $100 a share, you've got a 100% gain. Right at the bottom, despite the fact that the stock price is so low and that there's been overwhelming negative pressure on the stock, you can see the short interest down here at the bottom in the middle is only 1.86. So less than 2% of the total float that's outstanding is currently being sold short. So the shorts have kind of probably had their fill. They've made their money, and there's not a lot short interest in the stock right now. The graph looks horrible over the past 1 year period. So the colorful lines up here are the Dow Jones, S&P 500, and the NASDAQ, and this horrible black line at the bottom is your favorite and mine, Devon. Devon almost looks like Oxy from a few years ago, right? What's wrong with Devon? Let's see if we can answer what's wrong with Devon. If we look at the balance sheet over the past year, so this is on an annual basis. Of course, we don't have a full year of 2023 yet, so we have to look back. And remember always that past performance is not an indication of future performance, but we can certainly look back to sort of see where they come from and what the history is in this particular stock here. So you can see the cash and short-term equivalents, short-term investments is down quite a bit from 2021. Remember, in 2021, we had phenomenally high gas prices, energy prices in general, all of them, WTI, Brent, etc., natural gas even, really high prices. Which would have made the cash and short-term investments also look much better than what they looked in 2022. We'll have to see what 2023 looks like once we get a full year view on that one. Total debt pretty much flatlined here, right? So they didn't knock a dent in their debt year over year. In fact, their debt went up 2020 to 2021. When most companies in the energy sector were doing balance sheet repair and paying off some of their debt, Devon's debt actually went up. And that arguably is not necessarily a good thing. However, from a total equity point of view, there's been a nice big jump in terms of total equity. So from a shareholder point of view, most shareholders would probably be reasonably happy. Why would that be? So if we look at the income statement just below here, also on an annualized basis, you can see there's been a huge uptick since 2020 in terms of total revenue. So the company is just doing great when it comes to revenue. Total operating income is therefore also very, very positive, and total net income is also very positive. So let's take a quick dive here into sort of 5 different snapshots of the fundamentals of the company. Devon has positive earnings. The price to earnings and price to book are the most reasonable or most appropriate valuation measures we want to look at here. Price earnings, we're looking at trailing 12 months, right? So TTM's trailing 12 months. The price earnings ratio of less than 7 is very attractive because the industry, which is already very attractive as a whole, the energy, oil and gas, consumable fuels industry, attractively priced with a PE ratio average of 8.25. And what that means really, if you think about it carefully, is that you don't want to get into a new energy stock necessarily unless there's a compelling reason for you to invest or open a new position if the price earnings ratio is greater than, let's say, 9 or 10. Because you can see the entire industry average is 8.25. So if you can buy it for 8.25 or less, arguably speaking, from a price earnings point of view specifically, and I know it's only one benchmark, it's probably a good deal, right? If the PE ratio is 15 or 20 or whatever, it's probably overpriced. But that's only based on the price earnings ratio as one benchmark, which is an important benchmark, but it shouldn't be your only criteria for making an investment or not. Price to book, MRQ, means most recent quarter. Devon, once again, it's very attractive, 2.95, the industry 6.43. How about profitability? Well, this is not a bad picture at all. According to my little slide I took here, it says the gross margin is on par with the industry norm. The gross margin over the trailing 12-month period is actually 54. The industry is only 43. So comparatively, Devon has been doing much better. But look right at the bottom, very profitable, right? So Devon, with a net profit margin over the past trailing 12 months of 28% compared to the industry's 18%. So not only are they generating 10% more in gross, but they're also generating 10% more in net profit margin. So if you ask me, Mr. Oxy, what's wrong with Devon? I'll say, like, based on what I've shared with you so far, Not much, except perhaps for the fact that they didn't pay down a lot of debt when the prices were very high for oil and gas, and they were generating money hand over fist. They arguably could have knocked a dent into their debt. They didn't really do that. It just stayed flat, right? Other than that, so far, there's nothing I've shared with you that isn't necessarily reasonably good news or positive for the most part anyway, right? And you can knock my thesis full of holes and dents if you'd like in the comments. I look forward to your comments about this one. From a dividend point of view, well, this is not current as of today. Produces a yield of 10%. Devon has a unique structure, which is a fixed and variable dividend. You can read up more about that if you're interested and see what it looks like. But for sure, regardless of the fixed and variable component to their dividend, Devon pays a very attractive dividend yield, which is better than most of its peers in the oil, gas, and consumable fuels industry. It's also grown its dividends quite significantly over the past 3 years, but that's somewhat deceptive because that's mainly as a result of the variable dividend, which has skyrocketed because of high prices. Now that the prices have pulled back a bit and we have WTI and Brent sort of in a $90 range, they're not making as much money as what they did before. So that number will change when you look at it over a trailing 12-month period over the next 12 months. Growth rate. So if we look at Devon over the past trailing 12 months, again, it declined at a greater rate than its revenue. So what we're looking at here is the growth, and the growth decline a greater rate than the revenue. So I just showed you on the previous slide how the revenue had increased. If we look at the earnings per share growth over the trailing 12 months, it's not a good picture at all. The industry is averaging 64%. And remember, the industry came off a very low base before the prices spiked. And of course, everybody had great earnings when the prices were really, really high. And what I mean by that specifically is when oil and gas was sort of in the $130 range. But Devon has been a bit of a laggard in terms of earnings per share growth, not earnings per share per se, but earnings per share growth over the trailing 12-month period of -7%. Right at the bottom here, you can see the revenue growth. The revenue growth really is commensurate with the lower price of oil and gas, which they cannot really control. How about effectiveness? Are they quite effective? They are very efficient in terms of their a comparison to their peers with regard to return on assets, revenue per employees, revenue, return on equity, etc. If you look at the return on equity specifically over the trailing 12-month period, the industry is clocking around 42%, Devon's almost 45%, so about the same, right? And return on investment, not bad either. The industry is averaging 20%, and Devon's at 24.3%. Financial strength, well, this is the debt picture I was looking at just a few minutes ago when I looked at the balance sheet snapshot. Debt to capital ratio of 37%. It's not bad, you know, it's actually sort of very similar to most of the oil majors and super majors. You know, they're all sort of in the 30-40 percentile range or so. We see a debt to capital ratio for the most recent quarter, 37%. The industry average is 31%. And then the change in debt, not really much. There's nothing going on here. You look at the quick ratio. The quick ratio is how much cash do you have in the bank compared to accounts that you have to pay. We want it to be at 1 or above. So this is flying too close to the sun because we don't want to see it below 1. The industry is actually at 1, which means the industry as a whole is quite well managed when it comes to quick ratio or current ratio from that point of view. Most of the oil, gas, and consumable fuels companies have enough cash in the bank to meet their immediate needs over the next 30 days or so. But the interest coverage on Devon is pretty good, right? So right at the bottom of the screen here on the right-hand side, it shows you that Devon's operating profits are 11.65 times greater than its interest payments. So it would have no problem paying its debt at all based on its operating profit ratio down here at the bottom. So the industry is at 8.8, Devon's at 11.65. Quick look here at tip ranks for what it's worth. It's rated a neutral. You know, I started out making this video thinking to myself, what's wrong with Devon? Well, one of the things that's wrong with Devon is the fact that the analysts rated neutral, right? So the analysts are not saying it's a screaming buy, and they're also not saying it's a screaming sell, right? 10 is good, 1 is bad, 6 is sort of neutral, kind of in the middle. So everybody's sitting on the fence saying nothing at all. But that's in specific, more to the United States than in general. And that's why I added this little thumbnail here in the middle of the screen, because this is from my international portfolio, where I actually hold my Devon. And my Devon energy stock is in my international portfolio, which is multi-currency and has more analysts following it, right? So what you have here is a total, unlike tip ranks, of 28 analysts. 6 are saying it's a buy right now, 10 are saying it's an outperform, and 12 are saying it's a hold. No one's saying sell it, right? So it's probably the right thing to do. I would be sort of in the bucket here between the, let's call it the yellow and the brown line in the middle of the screen. I will hold it for sure. Maybe I think from here on out, we could see an outperformance. I'm not confident to say just buy it right now at $47. What's wrong with Devon, right? So the blogger opinions is just vloggers and bloggers, or ordinary people like me who know nothing, right, are bullish. But the investor sentiment overall is very negative. The technicals are very negative. The fundamentals are good though, right? So the new sentiment is bullish. It's easy to be bullish when the stock is trading at its sort of almost near its 52-week low, right? Let's take a quick look here at CFRA. This is one of the analysts covering it, and they have it 4 stars buy right now. That's their rating on the stock. They have a 12-month target price of $58. So if you get into Devon, and let's make it really easy and say you get into Devon at $48, you got about a 20%, 22% upside there. And then if this is just for interest more than anything else, if you invested $10,000 US dollars in Devon 5 years ago, today it would be worth about $16,000. If you can manage to generate a 15% annualized return over 5 years, at 15% compounded, you would double every 5 years. So $10,000 would have been 20. Now, this $16,000 that they're showing you here is excluding reinvested dividends. So if you are a dividend investor like I am, then your $16,000 would look more like $20,000, which means your annualized return compounded, including dividends that were reinvested over 5 years, would have been a doubling or 100% gain. The risk assessment here at the bottom, just very briefly, our risk assessment reflects, this is CFRA, our view of Devon's position as a large independent oil and gas exploration and production company in a highly capital-intensive industry that derives value from producing commodities with very volatile prices. Of course, they can do absolutely nothing about the price volatility. They are a victim of it, as you and I probably arguably would be as well. The investment rationale, and this is from CFRA, their recommendation is it is a buy. It's down 18%. And on that one, you could say, much like Uncle Warren Buffett has always said, buy when other people are selling and sell when other people are buying, right? So service cost seems to have leveled off so long as the US economy doesn't enter a steep recession. Well, we don't know about that. Crude prices should be resilient in 2023, leading to decent free cash flow, albeit weaker than 2022, obviously, because the prices are lower. Risks, a whole variety of different risks, significantly weaker than expected crude oil prices, for example, regulatory changes, which you cannot control because you never know what the Biden administration is going to come up with next, like when they do unexpectedly weird things like releasing the inventory of the Strategic Petroleum Reserve or something like that. You can't predict these things. You don't know what they're going to do. I don't know if they know what they're going to do, but they seem to pull a rabbit out the hat every now and then, which is not necessarily a good magic trick. Difficulty in replacing their reserves and the rising cost of inflation, that impacts everybody and anything. The 12-month target price for CFRA, $58, implies a 5.8 times multiple of enterprise value to projected 2024 EBITDA. I don't particularly like EBITDA. I like to count cash that's in the cash register. EBITDA, for those of you who can't remember, is earnings before interest, taxes, depreciation, and amortization. Anyway, that's a reasonable price target, $58. I see it going to $58 and staying there for a while as a more likely scenario than it going back to $77 or $78. I don't think we're going to see a huge jump in Devon Energy anytime soon. Some recent highlights. Second quarter crude oil production hit an all-time high of 23,000 barrels per day, which was an almost 8% increase year over year. The production costs of $15 per barrel of oil equivalent was down 6%. That's a good picture as well in a highly inflationary climate. They repurchased almost $900 million in shares. The board approved a 50% increase in the authorization program to a revised $3 billion. When companies buy back their own shares, this is beneficial to long shareholders because it's anti-dilution. Devon said that many of its leases, for 55% Delaware Basin, 60% Powder River, are on federal land. Now, we know that President Biden makes noises about leases on federal land very often. He says he's going to cancel them all. They're not going to issue any new leases, etc. But currently, Devon has a 4-year supply of permits based on the current drilling pace. The debt-to-capital ratio is average, 34%. 60% of the debt obligations have still a little while before they mature. So in a nutshell, my starting question probably that I should have posed at the beginning of the video is, what's wrong with Devon? Now, I shared a whole truckload full of information with you, and I can't find too much wrong with Devon. You could say the share price is something that's wrong with Devon because no one likes to sit on a 20% red line in their share portfolio. When you're down 20%, it looks ugly and it feels bad. But that's not really what you should be focusing on. You should be focusing, if you're a long investor, at a time frame that is suitable to you, deciding whether the equity that you are invested in is favorably priced for you to make an entry, yes or no. In the case of Devon, with a PE ratio of around 6 or 7, it's attractively priced, pays a nice dividend. That's pretty good too. It's in the oil, gas, and consumable fuels industry, which is the only sector that's absolutely 100% in demand. Everything else is kind of like, touch and go. We're not sure, right? I mean, you can invest in tech if you want, but you never know what the next technological advantage or benefit or change is going to be. Those things are completely unpredictable, or new entrants or whatever. What we do know for a fact is that oil consumption is still tracking at 100 million barrels of oil per day, regardless of what the politicians are trying to do with other measures, like renewable energy or whatever the case might be. So there are many, many reasons why you would want to hold Devon if you currently do, and why you might even be interested in adding to your existing position if you already have one. I don't think right now is the appropriate time to sell Devon Energy. But as I said a few minutes ago, you could always trim a little, or if you're rebalancing your portfolio, you can always decide to perhaps move some Devon money into something else that might be more rewarding. Like, let's say, just for the sake of argument, Petrobras, right? Which is the previous video I made. So let me know in the comments what you think. If you're long in Devon, I'm interested in why you're still holding it. If you think you're going to add more, tell me about it. And if you think you should, pick up your toys and go home, and just get out of Devon, then let us know about that too. So for now, this is Rudy signing off. Say thanks for watching. Talk to you soon. Bye-bye.